Hello and welcome back. I'm Natalie MacDonald and you're joining me for the latest Sydney Direct right here from Australia, where we bring you exclusive interviews with finance insiders on all the latest issues hitting the FX markets. Today I caught up with Ric Spooner at CMC Markets to talk APAC currencies and find out where he thinks they could be heading. Ric Spooner, many thanks for taking the time to chat with Dukascopy TV today. Always a pleasure to catch up with you.
Pleasure, Natalie.
Okay, so today we're talking APAC currencies. Let's start firstly with the Aussie dollar. Hints of an earlier than expected rate hike from the Fed is thought to be putting extra pressure on the Aussie dollar. Now, Morgan Stanley have gone with a 68 US cent forecast by the end of 2015, pushing even to a 62 cent forecast by the end of 2016. How does this line up with your own forecasts?
Well, look, I'm a long-term bear about the Aussie dollar. I think that the Fed's conversation with the markets has evolved to the point where the main concentration on what they have to say is going to centre not so much on guessing when the first rate hike will come, but very much on how fast the rate hiking cycle might be after that. And my suspicion is that the Fed is going to be at pains to make it very clear indeed that they intend to be very cautious and very moderate with this process, and that unless inflation shows signs of getting higher than they'd like, they're going to be really at pains to make sure that they don't cause the US dollar to rally too fast, too soon, or bond yields to rally too fast, too soon. And against all that background, I think that we're still open to the possibility over the next few months where we could see a downward correction in the US dollar, or ongoing downward correction in the US dollar, which of course would imply a higher Aussie dollar. Now, I don't see that as a certainty, but it's a definite risk. And I think the Aussie is vulnerable to having a look at, say, the 200-day moving average around 81.5 cents or that sort of thing before it then starts to decline to the levels you've been talking about.
Now, that Fed anticipation and also BOJ forward guidance is all also expected to create sort of a larger pullback on the dollar-Japanese yen cross also. But with the BOJ yet to commit to further monetary stimulus, could a weaker Japanese yen actually provide more support for that economy?
Well, of course, we've seen a very substantial decline in the yen against the US dollar and other currencies over the course of the last 12 months, and the degree of weakness is already impacting considerable stimulus, I think. But for the same reasons I think that the Aussie is vulnerable to a bit of a corrective rally against the US dollar, I think the yen could be as well. And particularly given Mr. Kuroda's comments, there is scope for it to perhaps get a bit stronger over the course of the next few months. But in the big picture, Japan may not be overly unhappy with that. A very weak currency has its own problems, particularly in terms of starting to make things tough for consumers in terms of buying imported goods.
Now, the globalization process of the Chinese renminbi continues, with the currency now under consideration for the SDR currency basket. Between this and also several currency swap rate agreements, could the renminbi, how does this impact the actual purchasing value and performance value of the Chinese currency?
Look, this is a very long-term factor. I think to some extent these sorts of initiatives, like for example inclusion as an SDR currency, if and when that happens, are really symptoms themselves of ongoing improvements in China's financial architecture, greater capital access or access to capital flows, improving their financial and banking system and so forth. Whether or not membership of the SDR actually improves the value of a currency is a moot point. Certainly in terms of the US dollar, I think that its value, role as a reserve currency and a major trade currency is generally thought to create some demand that it may not otherwise have. But in terms of the other currencies like the pound and the yuan and so forth, probably really it doesn't have too much of an impact on their overall valuation.
Where in sort of your APAC currency outlook, what's your buy-sell sentiment really at the moment?
Well, looking at the major traded currencies, I think, and looking at them against the cross rate so much, not against the US dollar, which I guess we've already discussed, but I'd say that the Australian dollar and New Zealand dollar are likely to weaken over time against the cross rates, mainly because of the impact of the relative importance to them of a softening Chinese economy. The yen, on the other hand, which has already fallen a lot, I think may correct a little bit from there, particularly if the Bank of Japan ends up either not or delaying any further QE stimulus.
Ric, always a pleasure to receive your outlook. Thank you very much for joining us.
No trouble, Natalie.
Sadly, that is all we've got time for right now, but we look forward to catching up with Ric Spooner of CMC Markets again in the near future. Do stay tuned, as I've got plenty more exclusive interviews coming up for you on Sydney Direct. For now, though, it's goodbye.